old way of trading gold is dead. Technical analysis, price action, and day trading gold without actually understanding what drives the markets is an amateur approach, and why most retail traders find it very difficult to find consistency and profitability in their gold trading. Now, I know this because in the last few years, I've helped hundreds of traders transform their approach to trading gold using fundamental analysis. Now, here's the painful truth that most gold traders don't want to hear. That whilst you're using support and resistance lines, drawing fancy patterns on charts, and trying to gamble on short-term price movements, professional traders are looking at something completely different: government bond yields and central bank interest rates. So in this video, I'm going to teach you in 2025 how to trade gold incredibly accurately using government bonds and interest rates. And you will learn how the relationship between interest rates and government bonds drives the prices of gold. I'll also reveal how central banks and interest rates play out through the bond market and how this gives you a predictive edge when trading gold. And I'm going to give you an exact step-by-step process that I've taught to all the hundreds of people in my trading community. So this isn't a get-rich-quick scheme. This is exactly how institutional traders actually trade gold. So let me start off by addressing the painful truth about retail traders trying to invest in gold. According to the data, 40% of retail traders quit trading within just 1 month. 80% of retail traders completely quit trading within 2 years. And after 5 years, there are only 7% remaining, which will probably give up quite quickly when they keep losing money to the markets. Why? Because they're completely focusing on the wrong things. Most retail traders approach gold trading just like this. They look for chart patterns and technical indicators. They try to time their entries into the gold trades and exit the gold trades using price action alone. They have no idea what's actually causing the price of gold to move, and they trade with emotion because they don't actually understand the fundamental drivers. And this is exactly why most retail traders completely miss the broader picture. They focus on short-term price movements and overlook the bigger picture fundamental drivers moving gold. And the bigger picture fundamentals come down to inflation, central banks and interest rates, and most importantly, the 10-year government bond yield. Now, understanding this is very important, and this is what separates the amateurs from the professionals, because the professional investors are tracking economic data that predicts inflation and what the central bank's likely to do with interest rates, because they understand the effect that's going to have on the government bond yields, and that is the key driver pushing the price of gold. So let's break it down. Why does government bond yields drive the price of gold? Firstly, gold pays no interest or dividends. It's just a metal that sits there. Now, government bonds, on the other hand, pays the investor interest and makes them a profit when they buy government bonds. And professional traders are only ever buying gold when the interest they're receiving from their government bonds are not protecting them from inflation. And the most important government bonds that investors pay closest attention to is the 10-year government bond. This is known as a benchmark because most investors buy this government bond to protect them from inflation. So as a professional investor, all you're focused on is how can I protect my money from losing its purchasing power from inflation. And there's always a tussle between whether the investor wants to buy gold or buy bonds to protect their money from losing its purchasing power in the real economy. Now, the most important thing you need to understand is that central banks create inflation using the money supply and interest rates. And central banks have a target of inflation they need to achieve. In most advanced economies, that's 2%. And to successfully achieve their inflation target, they increase the money supply and they decrease the money supply using interest rates to get inflation to target. Now, the interest rate on government bonds will rise and fall when the central bank adjusts its short-term interest rate. So they move together. So if inflation was falling below the central bank's 2% target, and this would happen in a weakening economy because the demand for goods and services by consumer spending is going lower. So the central bank needs to get inflation back up to their target. So what they're going to do? They're going to cut interest rates and increase the money supply. Now, for investors that are already holding bonds, they have a decision to make. Do I want to keep hold of the bonds that I own that's paying me interest, but the money I'm earning in interest is now going to start to lose its purchasing power due to this increase in the money supply driven by lower interest rates? Or do I buy gold to protect my money from this inflationary environment? Now, for other investors that are not holding gold or bonds, but they want to invest in one or the other, they start to ask themselves the same question. Do I now want to buy government bonds that are now going to pay me less interest at a time when the increase in the money supply is going to create inflation, and that means the purchasing power of money I'm receiving an interest from my bond is actually going down in value? Or do I just buy gold and protect myself from this inflationary environment? Well, logically, investors buy gold if the interest they're earning from their government bonds are going down in value because of a rise in inflation. So what they're going to do, they're going to buy gold because gold's going to be the hedge against inflation when bonds are no longer protecting them from inflation. And this explains throughout history, whenever central banks start cutting interest rates, investors that are owning bonds already, or maybe investors who are deciding whether they want to buy gold or bonds, they don't want to own bonds because the interest they're getting paid on their bonds, those dollars, for an example, are going to lose their purchasing power because the increase in the money supply is going to create inflation and there's less protection. So they go to gold. So let's look at what happened when central banks, Europe and the United States started cutting interest rates in 2024, push up the price of gold.
Right, when the Federal Reserve started cutting interest rates after finally getting inflation after COVID and the war in Ukraine under control, we can see the interest rate on the 10-year government bond peaked at 5%. And as the market started to price in these rate cuts, you saw the 10-year interest rate start to decline. And as you see the interest rate start to decline, you saw big moves in gold. When the 10-year government bond went from paying 5% interest down to paying only 3.6% interest, gold's price absolutely surged in value, jumping up as much as 66%. All right. And since then, the interest rate did go up a bit higher, causing the price of gold to decline, but then you've seen a steady climb higher in the price of gold ever since because interest rates on government bonds have continued to edge lower over time. So rates going from 5% down to 4.25%, you see gold jumping up by 84% in value.
Right, so now we've identified that investors buy gold when interest rates go lower. Let's look at the reverse. What happens when interest rates go higher, and what happens to the price of gold? In 2020, after COVID, as I'm sure you're aware, inflation spiked all over the world and went far above the central bank's 2% targets. And high inflation usually happens when there's an increase in spending by consumers, and central banks are going to want to raise interest rates to get inflation back down to target. So to control inflation, central banks reduce the money supply and raise interest rates. Now again, let's look at how investors view this situation. For investors that are already holding bonds, do I keep hold of my bonds that are already paying me interest, and the purchasing power of the money I'm earning in interest is now actually going to go up in value because the raise in interest rates will cause consumers to stop spending money and prices are going to fall? Or do I buy gold? And if I do buy gold, well, what advantage does that give me in a deflationary environment? Well, the purchasing power of money is now actually going to be going up in value because a rise in interest rates will bring down inflation and bring down prices, which means there's less of a reason to buy gold, because why do you need to buy gold if the interest you're earning from government bonds, the payments are now actually holding their value and actually increasing in purchasing power when inflation is falling? And now think about the other investor who's deciding, do I want to go in bonds or go into gold? Well, you already now know your answer. Investors are never going to buy gold when interest rates are going higher because the purchasing power of paper money in circulation is increasing in value, so there's no reason to own gold. So always remember this, gold only serves one role: to protect your money from inflation. And if interest rates are going up, they're not protecting your money from inflation because prices are going down. And actually buying government bonds and earning interest in a currency that's going up in the value is perfect. That's when you want to buy bonds. So let's look at this whole situation in reverse. When central banks started to raise interest rates in 2022 after COVID.
Right, so now let's look at the impact of higher interest rates on the price of gold. So after COVID spiked in 2022, the Federal Reserve started raising interest rates in March 2022. Here is a 10-year government bond interest rate. Now notice, at that time when the Fed started raising interest rates, the 10-year government bond, you can see on the right-hand side, was paying 1.69%. Okay, you can see that over here. So this was the price of gold at the time when interest rates are at that level. Now, as soon as the interest rates are going up, the 10-year government bond interest rate was rising, and the price of gold immediately tumbled by 23%. Okay, and then again, as I said in the previous video, when interest rates on 10-year government bonds are going lower, it makes investors buy gold as a hedge against inflation, and that is why gold then surges higher immediately as the 10-year government bond interest rate goes lower. Gold goes up 30%, but look what happens as soon as the 10-year government bond starts to rise again here. No surprise, gold's price goes lower in the market, and ever since then, the 10-year government bond has declined over this period of time from its peak in October, and that explains why gold since then has jumped up by around 69%.
So now we understand that bond yields don't move randomly. They're influenced by two key factors. Number one, inflation expectations, and number two, central bank expectations for interest rates. So when central banks are raising interest rates to control inflation, bond yields rise. And when central banks are cutting interest rates to stimulate inflation, bond yields fall. And remember, the price of gold is going up or down based on whatever is happening with the central bank's interest rates and bond yields. Now, what we've seen is that when central banks were raising interest rates in 2022 or cutting interest rates in 2024, that the 10-year government bond yield was rising or falling based on the market's expectations for what the central bank was going to do with its short-term interest rate. So when the markets predict that inflation is going to go above the central bank's 2% target, they start to predict that the central bank is going to start to raise interest rates, and the 10-year government bond yield starts to move, and that's going to cause the price of gold to fall in value. Now, in reverse, when the markets predict that inflation is going to fall, they start to predict that the central bank's interest rate is going to go lower, and the 10-year government bond yield is going to start to go down as well. And what do you think is going to happen to the price of gold? It's going to go up in value. So now you're starting to really understand this beautiful relationship between the markets forecasting where inflation is going to go and then predicting what the central bank's going to do in response, because they understand that the 10-year government bond yield, okay, is going to be going up or down in terms of the amount of interest being paid to the investor. And they're going to be deciding, do I want to buy gold or buy bonds? But they're only buying gold if they're looking at the bond market and saying, well, in an interest rate cut environment, I don't want to be earning bonds because this increase in the money supply is creating inflation. So I'm just going to buy gold. And you see big moves in the precious metal, for an example. Or on the flip side, when the central bank is expected to raise interest rates, they say, I don't need to be buying gold because the interest I'm earning on government bonds is actually going to be going up in value in terms of the purchasing power of the currency, because now inflation is going to be falling. So they don't buy gold and it goes down in value. So the whole key to the puzzle is, how do we predict inflation, interest rates, and bond yields? And that comes down to leading economic indicators. So leading economic indicators is economic data that predicts the performance of an economy, and that tells investors, are we going into an environment of growth in the economy, which will mean there'll be inflation. And then from that understanding, you start to build your views of where are bond yields going and where are interest rates going. Okay, and if you can get your ideas based on this hard data, you'll start to predict the markets with the professionals. So number one, business surveys are the most important leading economic indicators that predict if the economy is going to grow and go through inflation. And the two surveys are manufacturing PMI and services PMI, that both come out once a month. These two surveys measure business activity and inflationary pressures before they show up in the real economy. Secondly, consumer surveys like the UMCSI survey that comes out once a month in America tracks consumers' expectations for inflation and their spending patterns. And thirdly, break-even inflation rates predicts the actual levels of inflation over the next 1, 2, 5, and even 10 years. So you can see exactly where the markets predict inflation to go, and that will give you an idea where interest rates are going. So by tracking these three really important indicators, we can see with incredible accuracy whether inflation is expected to rise or fall in the coming months. Now, once our inflation expectations are established, we can start to build our view whether the central bank is likely to raise or lower interest rates. And this is done by analyzing implied interest rates, where you can start to use futures contracts to see the exact level the markets are predicting that the central bank's going to take interest rates at their upcoming meetings. So let's build this beautiful picture. You're looking at the business surveys, you're looking at the consumer surveys, you're looking at the break-even inflation rates. Let's say they're predicting inflation is going to go above the central bank's target. You then look over to the implied interest rate and you see at the central bank's upcoming meetings, the markets are starting to predict higher interest rates. And then you start to look at the 10-year government bond yield in the real live markets and it's starting to go higher. What are you going to do? You're going to sell gold, because you already know when interest rates are going up and interest payments on government bonds are going higher, okay? Plus the interest being earned on those bonds are holding their purchasing power and actually going to be going up in purchasing power, because inflation is then going to be expected to fall in the future. Nobody wants to buy gold, they're going to go buy government bonds. And again, in reverse, if you use your leading economic indicators, the business surveys, consumer confidence surveys, the break-even inflation rates that are predicting inflation is going to go below the central bank's target, and you start looking at the implied rates and the markets are betting on rate cuts, and you understand that when central banks are cutting interest rates and increasing the money supply is going to create inflation at a time when interest rates and government bonds will pay less interest to protect you from inflation, plus the interest you're earning, the purchasing power of that currency is going to be going down in value as inflation is going to rise. What are you going to do? You're going to buy gold in the markets, because now you understand why professional traders are buying and selling gold based on their expectations for whatever happens with the interest rate on the 10-year government bond. So that's why the new way of trading gold in 2025 is not going to be day trading. It's not going to be technical analysis. It's not going to be chart patterns. You're no longer going to be drawing support and resistance lines on your charts. Now what you're going to start to do is you're going to start to track the professional way of investing into gold. You're looking at the leading indicators. You're looking at the expectations for inflation. You're looking at the expectations for interest rates. And you're looking at the bond market, specifically the 10-year government bond. And now you know every time that bond is going up, in terms of the interest rate, gold is going down. If that interest rate is going down, gold is going up. And you're going to join the small community of professional traders who understand fundamentally what drives the price of gold. And this is exactly the education I've given to the hundreds of people that I've educated on my gold course, how to invest professionally and profitably when you're investing in a precious metal. Now, you can try go and do this by yourself, but I promise you, you're going to end up making loads of mistakes, spend months trying to find the economic data, and it's going to take you a long time to implement what someone could teach you in a week. And you could have someone like myself with a 10 years experience hold your hand through this process and make sure that you're trading gold profitably within only 14 days. So if you're interested, click the link below this video, get in contact with my team, and I'll see you on the other side.